Hey guys, Max here, and yesterday, the 14th of March, was pretty damn crazy to be honest. The markets moved all over the place. By the end of the day, they were down a pretty serious amount. The Nasdaq is now down almost 22% from its all-time highs, and yet I still hear people asking me, when is this market crash that I've been predicting going to arrive? Well, guess what? It's already here. Oil prices have dropped loads, which was great to see, but they spiked back up a bit and they're still very high compared to where we were just a few weeks ago, just not quite as bad as the absolute peak. We will of course cover all of that in detail, explain what's going on, plus we're going to look into the madness in China, so let's just get right into it. So what exactly happened? Well, the S&P 500 fell 0.7%. At some point during the day, it was up as much as 1%, but it couldn't hold on to those gains, so it closed in the red. The Nasdaq did comparatively far worse. It fell minus 2% throughout the day, and there really wasn't any midday rally to make things better. The S&P 500 is now down 13% year to date, which is pretty awful for just the first few months. The Nasdaq is of course doing even worse though, and it's now down 21% year to date and 22% from its all-time highs. Crazy volatility is once again just the name of the game. Traders, investors, really no one actually knows how to price assets right now, so it's changing really quickly, and there's nothing new about this. This has been the case throughout the entirety of 2022 so far. Now, there was a lot of talk of new rounds of negotiations by Ukraine and Russia, and that sent the S&P 500 up a little bit. As I said earlier, it spiked up 1% at some point, but it couldn't hold on to those gains, and it later fell back down to close in the red. Once again, markets moving that much on the supposed news of just negotiations, not even the potential progress of negotiations, makes no sense at all, and that volatility should not be happening, so those gains, they leave just as quickly as they arrive. Now, European stocks did not see any real major changes over the last week. They've been pretty consistent, small gains or losses, but in general, those markets have just been less volatile, there's less speculation going on, there are fewer retail investors in those companies, so really that's all to be expected. Now, there are, of course, continued fears of the Russian invasion of Ukraine, and that doesn't seem to be resolving, but some rumours, as usual, of negotiations are making way, but who really knows what's actually going on in those rooms? We're all in the dark on this, I'm afraid. Now, there are also big fears of inflation staying super high as usual. The US CPI came out a few days ago, of course, as we all know, and it was bad, as we on this channel expected. Now, an interesting perspective that's been going around a little bit is about the Ukraine war and inflation that's being spiked by it, and it's going to get really bad. We know that. We're going to see US CPI rise by more than 10% pretty much without a doubt, and there are a few ways that the current US administration and other Western governments as well can work to try and reduce the impact of this inflation, but all of them really amount to ending the war in Ukraine. Now, the first way to get inflation to fall is to get Russia to pull out and cancel the invasion, to stop war on its own accord, basically as a result of these sanctions, the financial pressure, and the international geopolitical pressure that's being applied to the country. Will this actually happen though? Who really knows? No one knows what's going on inside the head of Putin, but these sanctions and these financial and international pressures are pushing for this, and they are no small deal. Now, the second way is for the West to just stop caring about the war in Ukraine, to stop supporting Ukraine at all, to end the sanctions, to keep buying Russian gas and Russian oil, just to make things cheaper, and that would be a far easier route for us in the West to take, but it would be incredibly short-sighted, very unpopular amongst the populace, so I really doubt that will happen, and frankly, I hope it doesn't. Now, the third route, and the more interesting one, is actually to ramp up support for Ukraine. And yes, that will spike inflation in the short term, but in the long term, that could ramp up the pressure on Russia to try and help Ukraine win that war for themselves. A no-fly zone, for example, would be a good example of something like that. Now, that's not something I'm necessarily advocating for, but it's a viewpoint that is going around right now. I'm personally not sure which route the West will choose to go down, but they will have to go for one of them or many of them, as if they don't, inflation will seriously destroy our economies. Now, we're quickly going to move on to oil, gold, bonds, and crypto as usual before we finish today talking about the chaos in China. Now, oil prices, thankfully, actually fell yesterday. Briefly, they even dropped below $100 a barrel, which is very nice to see, but following that, they did jump up just a little bit. WTI crude oil is currently sitting at $102 a barrel, so down 6% in one day, which is still very good to see, and hopefully we can continue to see it fall in that direction. Gold prices fell along with oil, down 1.5% down yesterday, and right now, as I'm making this video, they're sitting at about $1,950 an ounce, a much more appetizing price for those of us who have been buying into gold. Now, bond prices have also fallen once more along with gold prices. Yields have risen as inflation is a certainty along with interest rate hikes as well. Now, the US 10-year Treasury currently sits at 2.14%. I think that's the highest we've seen it in 3 years now, after a 15 basis point rise in just one day. Elsewhere in the world, in Germany and in Britain, the 10-year yields there rose 12 and 10 basis points each, so major outflows from bonds all over the world. Now finally, into the crypto sphere before we go over east to China, no real major news here. Slight declines over the last few days, some volatility as you would expect, but nothing really to write home about. Bitcoin is currently sitting at about $39,000, just below that, and Ethereum is sitting just below $2,600, so pretty close to where they've been over the last week. Altcoins, as usual, seem to be falling slightly, less secure than the big cryptos like Ethereum and Bitcoin, so nothing surprising, but nothing major there either, 1 or 2% declines across the board. So I've been mentioning China a bit, and I've been mentioning that it's chaos. Why is that? Well, because their markets just tanked, and they just saw their worst single day of trading since the 2008 global financial crisis. Yep, you heard that right. It's that bad. It's worse than anything that we saw from the COVID pandemic as well. Now, there are two major concerns here and one minor one. The first big one is the usual regulatory risk of China being China. The CCP, the Communist Party, loves to attack big, powerful tech companies to bring them back down to earth, to arbitrarily tax them and limit their powers and extend the CCP's own influence. They have done this countless times over the last 2 years. They hit Tencent and Didi and Alibaba and Ant Group and a number of others. I literally couldn't list them all. It would take too long. So we saw the Chinese tech stocks tank for a long time, and I've been covering this the entire time. We've been talking about it on this channel, and most people just don't realize how bad it really is. You think that the market performance in the US is bad? Well, the S&P 500 from 1 year ago today is actually up 5%. The Nasdaq index from 1 year ago today is down 5%, but the Hang Seng index, the tech index from China, is down 36%. From its all-time highs, it's down even more, 44% for an index, let's not forget. That is insanely bad, and that rout has really been going on for over a year ago now. Now, in a similar sort of vein, US listed Chinese stocks, which we know of as the Golden Dragon Index, so Chinese companies but listed on American markets, they are down 78%. That is ridiculously bad. That's worse than the 2008 financial crisis, and it's on par with the Great Depression almost 100 years ago, which was the worst ever financial crash. Now, the risk of the CCP, the Communist Party, attacking companies never actually ended. It just stopped being talked about by companies like Bloomberg, but that risk has now flared back up as we are seeing the CCP start to take action against private companies once more. As we on this channel have talked about for so long, this was never going to end, so markets are rightly terrified. Now, to make matters even worse, but this is the minor problem here, the housing market crash never ended either. Chinese real estate firms and their bonds continue to collapse in price, and we see their yields soar, making it impossible for them to take out any future debt. The average bond in this industry is trading at 65% of its value. It's down 35% for a bond. That is insane as well. And it just kept getting worse after the media forgot about Evergrande. Then to make matters even worse once more, China is seeing slowing economic growth, which is very worrying for China. They've been growing for decades now, and it's causing the yuan, the Chinese currency, to weaken on these spheres. Now, the argument the whole time from those who support China and don't want to see their economy fall is that actually China's economy is still growing so fast that property prices don't matter, that the property industry doesn't matter. But guess what? Those people were of course wrong. It of course does matter. Now, the other major reason and the news for why Chinese markets have started this collapse all over again is because China is of course loosely aligned with Russia, and there are fears that China will get hurt by the Ukrainian invasion by Russia if China decides to aid Russia. Russia have specifically and directly asked for China to aid them in their invasion. They need the support, so apparently they didn't have much choice, but it is a little bit unlikely that Chinese will help in any major way. Maybe they'll send some advisors or a little bit of equipment, but if China gets sanctioned like Russia has, their markets will collapse even further, and the CCP actually does care about this. So these rising tensions on the Ukrainian invasion and China almost being dragged into it by Russia is very bad news, and investors are terrified, so asset prices are collapsing. China probably knows this. They've been very careful about supporting Russia in this invasion already. There's been an unexpectedly strong Western response to Russia's actions, so the country of China is being cautious about helping Russia, and hopefully they won't go any further and actually help them with material support. Now, the decoupling of supply chains and finance in general is looking more and more likely between the West and the East, and over the next 20 years, I personally believe that major efforts will be made to build things not made in China by the West. In fact, this is already happening, but it will continue to accelerate and it will have huge impacts on China's economy. Now, this isn't too surprising to China. They've always known that they would never stay the workshop of the world forever. As wages increase, as China develops, they become less competitive with manufacturing, and manufacturing would naturally move to a poorer country. We've seen this happen with 50 other countries in the past. It's very natural and it's very obvious from the start, but the challenge for China is creating a service-based economy, so as they get richer, they don't have to be the workshop of the world in the future. But the problems with that right now is that China's not ready for that step. They are not yet a service-dominated economy like the UK or the US is, so decoupling now would be seriously detrimental to them. Now, the reality is there is so much more to say about all of this, but the video will end up being over 30 minutes long. So instead, I'll be putting out a specific video dedicated to this turmoil in Chinese markets shortly, recapping everything that's happened over the last couple weeks and even going back months, explaining everything, and that should be out for you guys in a few days. There are, of course, some more updates regarding the war in Ukraine, the Russian invasion, but we're not going to tackle that today, again, because otherwise this video will just be too long. There will be a video coming out in a few days explaining just what is going on there, that missile strike by Russia, which was a pretty huge provocation towards the West, and the potential, albeit an unlikely one, of China getting involved in the invasion as well, so look out for that video. I'll hopefully also be putting out a video on Stoic Politics, my second channel, the link for which is down below in the description, about the Iranian missile that was fired into Kurdistan and what the US's reaction to that might be. So let me know if that sounds interesting, and if it does, if you want to hear about it, then go check out that channel and subscribe down below. If you enjoyed this video, then make sure to like and comment and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.